What's up, everyone? It's Karthik with MoneyVest. Welcome on board for our Wednesday market open live stream. Thank you so much for joining here. And we are seeing some nice little recovery in pre-market hours here as QQQs is up 60 basis points. We got the S&P 500 up over 30 basis points. NVIDIA up over 1.3%. Tesla also pushing higher, up about 0.5% right now, as Bitcoin also trading back to over $105,000 as we are seeing BITX also gapping up over 4.5% in pre-market. Ethereum also trading back up to over $35, almost $3,600 as well, as Ethereum ETFs and of course BMNR are also pushing higher pre-market, up over 4.8% at the moment. So hope you all are doing great and are having a fantastic start to Wednesday morning. Good morning here. And we'll take a look at all the questions, everything, as you guys already know. In terms of the economic catalyst, CPI numbers are scheduled, but I'm assuming that they're going to get delayed and they're not going to come out due to the government shutdown. However, we are very close to ending that longest government shutdown in the US. So depending on how the vote goes and what kind of bills are negotiated in White House, we are going to get some updates very soon. So next resistance on Ethereum is going to be closer to this level right here, 3667. So just call it almost 3700 is where the next resistance is going to be for Ethereum. This is where we have been getting rejected more recently. This is also where we found support before finally breaking down, and that is going to be that next target and that resistance to watch for Ethereum. So what ETFs do you recommend medium risk? So Diogo, that is a very open-ended question, I would say. Risk is very personal to each investor. So we really have to first gauge on what you consider to be medium risk. Obviously, if I were to put that into categories, I would put low risk as something as government bonds like treasuries. High risk would be more geared towards leveraged positions, options, as well as private equity, venture capital. And medium risk could be index funds and ETFs. And again, depending on the stocks that you're trading, could be somewhere between medium and high risk. So it is very open-ended in regards to what you consider to be medium risk. But medium risk I would put down as equities, index funds, ETFs, as well as individual stocks. Crypto can also be on the higher risk bucket, but we've got a whole ETF shopping list on our Patreon, so you can pretty much download that spreadsheet and it will break down specific goals, specific objectives that you're looking to achieve, and then you can essentially look at what is the corresponding ETF that's there meeting those criterias. So we look at everything, right? We look at the liquidity, the assets under management, the issuer, everything that we cover. And I've put together that list for everyone. So, David, what are my thoughts on OpenAI, NVIDIA, and other data center circular investing? I think there's definitely a lot of, intertwined deals that are happening for sure. For some reason, I'm not completely convinced if that's going to equate to that much value creation or if that's going to translate over to the earnings side, which is exactly why I am careful and cautious picking up every single AI company out there, every single hyperscaler or compute or data center company. But the fundamentals have to justify the valuation and the pricing. So if OpenAI was is a publicly traded company, then it would be trading at an insane valuation, just from these deals. I think just from these circular flows, then we'd be looking at OpenAI trading at an insane multiple. But because it's not, then obviously a lot of other companies are piggybacking off of OpenAI, and as a result, their stocks are obviously pumping to new all-time highs. So, the bottom line is we have to let the numbers speak for themselves. The data is what's really going to matter over the next couple of years. Really just call the next 8 quarters are going to be very, very important for the market because this is where the build out is actively happening in the artificial intelligence space. Even countries like the UAE just, signed an agreement with the US that they're going to be, building one of the largest data centers in the Middle East. They're going to want to buy a lot of chips from NVIDIA. And so that's going to eventually reflect NVIDIA's numbers. And so, as I've always mentioned before, at the end of the day, the numbers is what really matters. The market always wants to try to predict what this story is going to mean for the numbers. That's why stock prices move, because, there's no other explanation why valuations and prices move 252 times of the year versus the fundamentals only change 4 times a year, because the companies only actually report their earnings 4 times a year, right? So it wouldn't logically make sense for the company's valuation to also update quarterly, right? Because they're reporting those earnings quarterly, but that's not how the market works. Since it's so liquid, since we are trading on perception, since we are trading on expectations, valuations and prices do indeed change quite a bit. And this was actually one of the opening remarks of one of the books that I read on investing. I forgot what the name was, but in that book, there was literally a finance professor talking about with a class full of finance students that stocks fluctuate on a 52-week high-low basis. They fluctuate their valuations 50 to 100%. It's possible for a stock to be trading at $25 and then be trading at $50 and then back down at $25. So you can see how much perception changes, even though the company fundamentals are only reported 4 times a year. So that's what we have to really always try to dissect. And the mispricing always occurs where there's an overreaction. That's where the mispricing is, right? So that's why the markets are not perfectly efficient. If they were perfectly efficient, you know what would happen? Every piece of news that comes out would be perfectly aligned with the numbers and would be priced in, and there would be no edge. There would be no mispricing, and there would be no arbitrage. But because there's an overreaction to things, on the upside and on the downside, that's where the opportunity lives. It's in the overreaction. It's in the mispricing. It's in the arbitrage, because we always overshoot on the upside and on the downside, right? So if there's a mean reversion that takes place, for example, just giving you a very simple illustration, if this is the mean, right, this is the average market growth, which is linear. Markets are growing, 7 to 8% per year. Stocks are growing earnings, 8 to 12% per year. Whatever the case might be, some companies are growing faster, some companies are growing slower. It averages out to, let's say, 8 to 12%. What happens with prices? Well, they go up and they go down. They go up and they go down, right? They go up and they go down. And the opportunity lives in the mispricing. It's going to be living right here. That is the inefficiencies that investors have to really take advantage of, right? So that's where those gaps of overvaluation, undervaluation, that's where the opportunities are. And so we always have to ask ourselves, are we getting compensated for that level of risk, or can the risk reward get better? That's really where our analysis has always been. So yeah, long answer short, everything will eventually trickle into the numbers, and the data will speak for itself. The companies that are going to be the most successful are the ones that are going to back it up with actual data, no fluff, no talk, just pure financials and growth. So yeah, that makes sense. Beautiful answer. Hi, Karthik. Good morning. Good morning, everybody. The news talks, numbers scream. Yes, that's what matters always. Okay, so thoughts on SKHYNIX crawling. So what is the ticker symbol for that stock? If you have it, then I can take a look at it. Looks like it's listed on KRX. But if this is the company, which from the likes of it, it looks like it is, looks like we're on a very strong uptrend, incredibly overbought right now. Fundamentals seem to be improving. Revenue is growing quarter after quarter. Profitability also very strong. And this is a company based out of South Korea, as you pointed out. Manufacturing and sale of semiconductor products. Its products include dynamic random access memory, flash memory, complementary metal oxide semiconductor image sensors, and other materials and products as well. So yeah, from the looks of it, looks like a very strong contender in the semiconductor space out of South Korea. However, just obviously be mindful of the technical levels that it's trading at. Very, very overbought, and obviously it has, more than doubled in the last few months here. Literally since August, the stock is up over 150%. So I would say, obviously, be very careful, be very cautious with where we are on the technical side. And I would put down a support at 532,000. I'm not sure what the currency is for South Korea, to be very honest. KRW. Could be a learning lesson for me. South Korea currency. So we're looking at South Korean won. Okay, so Korean wons. 532,000 Korean wons. That's also going to be aligned with that 50 EMA. And resistance is going to be all the way up to as much as 634,000 Korean wons. So, all right. Welcome everybody. Again, thank you so much for joining. Any questions, any specific questions, I'm more than happy to answer. Fundamentals, technicals, options, macros, whatever it is, I'm more than happy to cover and share my thoughts. Opinion on BBAI, so that's going to be Big Bear, I believe. And of course, this company has had a whirlwind of volatility here. It's been trading in a very strong range of resistance up to as much as $9, getting rejected there. A very strong support down as much as 460, so it's been a trader's paradise. Resistance is going to stay put at 650 right now. It's where we are getting rejected at the moment. And of course, the support level all the way down here. So lots of consolidation is what we are going through for this stock. Continues to trade above its 50 EMA on the weekly time frame, which is good. So holding up really well. And there is nice little higher low also forming up. So it continues to kind of validate that support really well. So pushing up almost 6% pre-market, coming up to that resistance. That's the level that I would be watching for Big Bear, roughly around 650s. So that's where we are. What's your thoughts on SoftBank selling the entire stake in NVIDIA? I think they needed money for other initiatives and other projects. I think that's fair. That doesn't mean that NVIDIA is not a great company anymore. I've always mentioned this before in my videos many times before. You could be selling for a whole lot of different reasons, right? So always remember, if somebody tells you that I sold a stock or I sold something, they could be selling for a bunch of different reasons, right? But if somebody tells you that I bought a stock or I bought an investment, they're only looking to make money, right? So in other words, when somebody buys an asset, they are bullish on that asset. But if they're selling that asset, that doesn't necessarily mean that they're bearish on that asset, right? So that's something that I always want you to remember. And something that I learned also is buying is only for one reason. You want to make money. But selling could be for multiple different reasons. Tax reasons, liquidity reasons, margin reasons, leverage reasons, bearish reasons. Could be a lot of different reasons, but it doesn't always equate to that person being bearish on that. But buying, yes, we're bullish. So, let's see. Trust Your Well, what do you think about SoundHound AI? I feel like there's so many companies just putting the word AI right next to it. It's a Big Bear AI, SoundHound AI. We just gotta be careful with those, right? I mean, a lot of companies are going to be born out of this AI boom, but how many of them are going to How many of them are going to actually survive? Depends very much on their fundamentals and growth. And once again, I will reiterate, right? Hype dies, data survives, and that's what we have to always be mindful of. So SoundHound AI support level is going to stay up roughly here at that 50 EMA, saying roughly around $13. From the looks of it, pretty inconsistent on the fundamentals. I mean, you got massive losses for this company. So again, just be careful. I mean, you've got a stock trading at 40 times sales, right? I mean, do you really want to put money into something that's 40 times sales, generating massive losses with little to no cash flow and a lot of debt? I don't. I would trade this, but I would never be looking at it from a long-term investment standpoint, at least not right now, until the fundamentals get better. And so support level $13. If it continues to trade down, next target roughly in the 950s to $10 for this stock. MoneyVest AI. No, we won't do that. We won't do that. But that's funny. We do have a MoneyVest AI bot that we're creating, that we are going to be testing, and we're going to be sending a lot of updates through that AI. But at our very core, we're going to be a community first, community, in other words, people first, community, AI second. So, okay. Let's see. So SoftBank we already covered. Viking Therapeutics. Let's take a quick look at their stock. VKTX. The market cap for this $4.5 billion. Wow. Fundamentals. Look at this perfection, right? Absolutely perfection here in terms of income statement. Revenue 0. Is there really no reported revenue for this company? I really want to look. I really want to see if there is actually no revenue, or if TradingView is just like not able to pick up on the. So we can look at the SEC filings. Let's look at the annual filings, and we'll come over to, let's say, this PDF. Or let's just go over to this one. Come over to financial. I'll just scroll down a little bit just to see if this company is actually not reporting any revenues. There we go. What are we doing looking into these stocks, guys? Like, why? What's the point? What is this? Is it purely built on hype? Like, that's because you can pull up any company's SEC filings and look up what it actually is doing in terms of numbers. This company has no revenue. Like, we're looking into a stock that has no revenue. So yeah, I would skip this, but resistance roughly around $42, support level $22, $23. That's where it's been consolidating sideways. From 23, it has rallied over 80%. Resistance, like I said, it's going to be $41, $42 for the stock, and all the way down here is going to be that support. All right, so yeah, so when MoneyVest is a publicly traded company, there will need to be MoneyVest AI. LOL, stock jumps 300%. I know, right? Absolutely crazy. But if God willing, we actually go to public markets, it's gonna be it's not, well, obviously I can't control market dynamics, but we're gonna be a fairly traded company because we put so much emphasis on valuations. We cannot be a crazy valued business, right? So it would be very fairly traded, at least up until IPO. After that, I have no control. After the market forces take over, so I can't do anything. Yeah, so I think talking to real people will become a luxury and something many people will seek when looking for customer care. I agree. I think that it's already happening. Nobody wants to press buttons and talk to a robot, obviously, and we just want to talk to real people, right, when we're trying to get help. So customer service, very, very important. Talking to real people, I think, so important. Yeah, frothy markets tend to pull people that have very little knowledge on how to analyze the fundamentals of a company. I agree. I think that's really what we've seen over, through many, many cycles in the market. That, and of course, the major big saying goes that if your cab driver is talking about it, that's probably the top, right? And it's happened so many times is froth. And when we go through this environment of easy money, right? Easy money is that it doesn't matter what you put money into, it's going to do well. That is easy money. And that's when a lot of people get sucked into the market, but then it's like a whole rinse and repeat process, because on the next correction, the next bear market, a lot of people quit. That's the unfortunate part. That a lot of people quit investing altogether. They're like, okay, it's not for me. For whatever reason, obviously the markets play a big role with that sell-off, but time and time again, we understand that as long as earnings are growing, as long as business is growing, there is leadership and there's domination, then there's going to be strong growth long term. Gary, Caddy Unseen VCR shares are very overbought. Please buy with cautious. No, I think it's going to be very similar to, Elon Musk. He's literally talked about his own stock, about selling his stock so many times, right? So that's pretty crazy. But Vault, yes, getting to your question, what do you think about Nebius at this price? It looks like a strong support where it is currently. Let me just take a quick look here. NBIS. And so we're still inside this symmetrical triangle, I would say, and support level for Nebius is going to be closer to $87 and a resistance all the way up to this lower high at 129, 130. So yeah, that's where we are in a bit of a, symmetrical triangle. If it does pull back further, I would look at $87, $88 as a better entry point. Risk reward is going to be significantly better than where we are right now. But even at these prices, I would put if you're trading this, I would put a stop loss below 95, and then a target up to as much as 135 to 140s for Nebius. So yeah, that's my quick thoughts. Ken, check out PG, looking really good. Your audience should be selecting quality companies that are beaten down. Yes, I agree. I think it all comes down to high quality businesses that are fundamentally strong, that are beaten down significantly, right? So the ones that we were looking at, of course, were the 3Ms, Meta, Microsoft, Melly. But if you take a look at Procter & Gamble, as Ken suggested, also a pretty good, business. Household products, personal, non-durables, starting to show some signs of life here. It is still in the context of a downtrend, so lower highs and lower lows. So the trend continues to be pretty weak. So that is the overall trend there. But there is some accumulation happening, right? So there is the L3 banker oscillator, showing signs of some heavy buyers coming in, and a resistance up to as much as 156, 157. So, right now, yes, there's a little bit of upside, but on decent volume, it has to break outside of those levels, getting up to 160s and 170s in order for us to see some momentum, right, to the upside. So yeah, Nebius we covered earlier. VKTX is a hype company. That was my first stock when I was investing penny stocks. Absolutely crazy. 50 years mortgage is absurd. Basically rent your whole life until you die. Yeah, 50-year mortgages, what are your thoughts on that? Like, I'm really curious, what do everyone think about a 50-year mortgage? Like, for me, having debt is stressful, right? Even having, 2 to 3% debt can sometimes be stressful for me. And so I've never had a mortgage in my life because everything that I've bought has been cash so far. But for my primary residence, I am planning on picking up a mortgage, but I'm not planning on extending the years. I'm actually planning on decreasing. I want like a 5-year mortgage or a 7-year mortgage or a 10-year mortgage at best. Even if that means like I have to make extra payments each year to try to build down the debt as quickly as possible and build that equity as quickly as possible. For 50 years, I would be so stressed. I would be like, 50-year mortgages only benefits the banks. I know. The amount of interest that you'll be paying on a 50-year mortgage is crazy. It's insane. For a 400K home, it'll be $2 million by the end of those 50 years, which is absolutely nuts, especially if you are looking at interest rates right now. If you are locked in on, let's say, a sub 3%, okay, you can make sense of it because it's extremely cheap money for a really long time. And there's a lot of things that you can figure out along the way. But anything over 5% for 50 years is really just a death sentence. It's insane. Yeah, you would just be like, subscription for housing. That's literally what it is. But I think being completely debt-free, the amount of, I'm not completely debt-free right now, but I'm planning to be in the next 6 months. I really want to be debt-free. That's like one of my big goals over the next 6 months is to just eradicate all debt. And the level of peace I know that it's going to bring me is going to be just a huge weight off of your shoulders once you're completely debt-free. I think in personal finance, obviously there's the financially sound, mathematically optimized, efficient goal of, hey, you've got a 2-3% mortgage. Why pay off debt when you can invest for 7-8%? That is the financially sound, mathematically logical option. I totally get that. But a lot of people overlook the emotional benefits of paying down debt, right? Not everything is according to the spreadsheet. Some things you have to do as per your own emotional needs. And, if being debt-free is the wiser choice emotionally, then yeah, financially it's never going to be a good decision because you can actually invest and earn more. But if it helps you sleep better at night, I would always recommend doing that. It would only lower your monthly payments by about $300 a month if you have average about $400,000 mortgage. Yeah, I mean, see, the trade-off is just insane. It's crazy that that 50-year mortgage is even something that would consider. Like, imagine no payment, no down payment, 50-year mortgage. Imagine that would be like the 2008 2.0. That would be like the housing bubble point 2.0, basically. 0% down payment, 50-year mortgage, and you're all set. That would be crazy if that happens. I mean, the real estate boom, even for investors, would be crazy. Prices would go skyrocket. So, okay, that extra 300 people wouldn't save it. It would be spent elsewhere. Yeah, true. But in this case, it's essentially, you're either financing the bank's interest or you're spending it in something that brings you joy, brings you experiences, whatever. But you're spending that extra $300 in interest. That is quite literally not going anywhere. So, thankfully, I'm debt-free, Rax. That's amazing. That's great. How many people here are completely debt-free? I really want to know. Let's just do a very quick personal finance poll, something that we haven't really done ever. So let's do this. 100% debt-free. And then I'll just do half debt. Let's see what's the percentage. I'm sure there's going to be a lot of course, mortgages and auto loans. I totally get that. But if you have a lot of people that are debt-free, that's incredible. I mean, that's literally no stress. Yeah, the only debt I have is my mortgage. I could pay it off, then I'd have no money for the markets. Yeah, so I mean, I'm talking, let's just say, if you could, obviously, then you would pay it all off. So that's a good way to kind of have that optionality, right? So you have the choice, but you're choosing not to because, again, it's probably a really low rate. Like I said, anything under 4%, it makes sense why you want to keep it. Anything over 4%, I think that should be priority number one, right? If you've got 6, 7, 8% student loans, auto loans, credit cards, whatever, that needs to be cleared up because that's a huge drag, right, on your growth. So, yeah, 2.75 doesn't make any sense to pay it off, Valerie. I agree. I think anything, like I said, anything under 4% is worth keeping, and that's what I have right now. But I'm just like now at a point where okay, I just want to be done with it. I just want to just write a check, be done. And then there's no drag. Every month there's absolutely no drag. Nothing holding me back. Everything is just going towards investments, going towards compounding. Whether that's real estate, whether that's stocks, whether that's options, nothing is going to pull me back after. And then you don't see linear. You see more like a exponential growth once that big weight is off your shoulders. So. Mark says, this recently debt-free, but I paid it all off. That was tough. That's incredible. Amazing. That's great. Only way to get money out of real estate is to refinance or sell. Yeah, that's true. Especially if it's your primary, then that's the only way to actually do it. But it becomes difficult. So, okay, we've got a pretty good split. 49-51. That's still way more than what I'd expected. On the 100% debt-free side. So that's incredible. That's amazing, you guys. Review Open Door has a good entry point below 5. Then some hedge fund guy ripped them. Seems to be recovering. Did you ever look into this one? So Open Door we have. We did look into it. I think they're doing like a crazy stock dilution. So just be mindful of that as well. So resistance for Open Door is going to be coming up to as much as 970. So that's going to be that resistance with a support level at 690 to as low as 560. So if it does trade down to these levels here in the 5s, low to mid 5s, I think that would be a good, decent swing trade opportunity there for Open Door. So in Eastern Europe, most people are debt-free. We are afraid of the banks. I know there's a lot of really, really low interest rates in Europe, especially in Scandinavian countries. Like interest rates are insanely low. Even in here in the UAE, interest rates are really low. Mortgage rate, the one that I'm qualified for, I haven't utilized it, is around 4.5%. So 4.5% for real estate. Auto loan, I just got approved for 3.5%. So I don't know how much auto loans are in the US. I think it's closer to 7-8%, might even be higher, 10-12%. But yeah, interest rates in parts of Europe, of course, and here in the UAE, really, really low. And just think about it, right? Even at these lower interest rates, I'm still not comfortable taking on debt. But maybe in the future, you never know. So, okay, let's go over some stocks here. Clack Corporation analysis. I've invested 4 years already, total 500 stocks. Time to cut some. So Clack Corporation is a phenomenal business, I believe. So, bull flag formation right now at the moment, in my view. I think we are a little bit overbought here on the weekly, but daily time frame does show us some pretty nice lower highs and, of course, this higher low. And this bull flag could potentially break to the upside. Resistance is going to be all the way up here at 1281 with a support level that's going to be sitting right about there at around 1150. So that is going to be that support to watch for Clack Corporation. So do you think the agent population, assuming what you meant there, Lamp, boomers will cause a mass sell-off in the near future with selling off housing and stocks? I mean, obviously, I'm not too familiar with what the composition is, but it's going to be a rough guess that, yes, they are the ones who actually own a lot of stocks in real estate. But at the end of the day, when you do sell any asset, the second problem you have, the first is taxes. What is the second problem you have when you sell an asset? Is where to put that money, right? So obviously, nobody wants to hold on to cash, right? Because especially if you are somebody who is in your retirement, what you want is income, right? Income coming in. And the only way you have income coming in is if you've invested that cash, right? Cash in itself is not going to generate a lot of income, like 3 to 4% per year at best. So the only way you can actually generate income is through investment vehicles and assets like stocks and real estate. So it doesn't make any sense for for investors, even if they're approaching retirement or after retirement, to completely exit out of that positions and just stay in cash, because that won't meet their goals. After you sell your assets, you buy a mansion, Lambo, and party every night. But you need a purpose. I think that's really what everybody needs. Is once you're done with your work and everything, then you need something to actually have meaning, have purpose, because even that gets boring. Going to the beach, partying that gets boring. Even though I haven't lived it, but I can sense it. That starts to get boring. And if you have meaning and purpose, something that you're working towards every day, I think that is what is going to keep you active, every day. So SE, we'll take a look at. Walt, I'm from Poland, Eastern Europe, and have a lot of people are in debt, but most of them have just mortgages and maybe auto loan. But I don't know people that take debt to buy iPhone or stuff like that. Yeah, I know, it's crazy. I mean, with the buy now, pay later, so BNPL, the things that have been financed are crazy. Crazy what people can finance these days is insane. You can even finance food. Unbelievable. But yeah, let's take a look at SE. And so been selling off quite aggressively here from its highs of 198 down about 27-30%. Next support all the way down at 118, 119, but there is some support down here as well, 139, 140 here. It is pretty oversold, so can be looked into from a swing trade perspective. It is gapping up pre-market here, so I would watch for that support at 139, 140, resistance all the way back up to 171, 172 for SE. Yeah, AMD has nice momentum at the moment, getting a nice little lift after Lisa Su's announcement of nice 30+% growth expected for the company, and support level roughly around 240, resistance up to 266 for AMD. BNPL financing burger bills from McDonald's. It's insane. What is one penny stock you would throw $2,000 into right now? Penny stocks is something that we never cover on the channel here. So our basic threshold for looking into companies has been always $1 billion. might even be like $500 million. That's pretty reasonable. And liquidity. The volume has to be minimum 1 million shares traded per day. And from a stock price perspective, at least over a couple dollars. But penny stocks, just really not something that we look at actively. But if you've got any, I'm more than happy to analyze them, but it's not something that we're actively looking into. So yeah, that's where we are. But I did open a few different spreadsheets that I wanted to go over for everyone. So, this is the threshold spreadsheet, as I like to call it. So it shows you exactly, where the markets are, S&P 500 relative to their all-time highs. And as we know that within 0 to 5%, it's considered a dip. 5 to 10% is going to be a pullback. 10 to 20% is a correction. 20 to 30%, anything over 20 to 50% is going to be a bear market. And then anything over 50% is a crash. So if you were to consider 51 years worth of data and the percentage of time spent in each of those thresholds, very quickly you'll realize the lower we go down this table, the more rare that becomes, because the markets have spent most of their times. In fact, 92% of the times, the markets have spent within 30% of their all-time highs. Going down by more than 30% becomes incredibly rare and something that we haven't seen in a very long time. And so this gives you a nice little idea that, okay, the next time I see the S&P down over 30%, for example, from all-time highs, it's only happened 8% of the times. I mean, at that point, volatility obviously is going to be through the roof, and that's going to represent incredibly good risk-reward ratio. But where are we currently? We are where we have spent 40% of the last 51 years, which is well within 5% of all-time highs. So this is nothing unusual. This is nothing out of the ordinary. It's a very normal market. And even well within 10%, this is where we have spent majority of the time. Over 56% of our time has been spent within 10% of all-time highs. Let's think about that for a second, right? I mean, the S&P 500 has spent over 50% of its time within 10% of all-time highs. So yeah, so next time we start to get those corrections and those pullbacks, I mean, this is something that I always refer to. How much are we down from all-time highs? Because it helps us understand those market dynamics. Okay, Jeremy, yeah, spreadsheets. We'll restart the Saturday spreadsheets very soon. I'm working on a few different ones that I think are going to be super helpful for everyone. Again, some out-of-the-box creative spreadsheets that are going to help us make sense of this market. And the most important spreadsheet that I'm going to be working on is going to be coming out towards the end of this year. Granted, we close strong because the whole idea behind that spreadsheet is going to be 3 consecutive years of 10+% growth in the S&P 500 and what the subsequent performance was for year 4. I think that's going to be the most important spreadsheet for this year going into 2026 because we are on a 3-year streak of this S&P 500 just roaring 20+%, 20+%. This year so far we're up over 16%. And so that is going to be that analysis coming out in December for 2026, which I think is going to be very, very important. It's going to give us a little bit of insight. When was the last time it happened and what was the results for year 4? And we already have to keep in mind the Benner cycle. The Benner cycle is something that has a very high hit rate. It has been very accurate as well. I've done a full study, full analysis on this on the channel before. But this right here, as you can see, 2026, right after 2023. So right here is 2023, the one that I'm pointing to. That was, the years of, incredibly good years, right? So C is going to be 2023. And then, of course, from 2023 to 2026, that's been a very strong 3-year rally, right? So 2022, towards the end of 2022, beginning of 2023 was the perfect time to load up, right? That was a buying opportunity because years of hard time, low prices, good time to buy stocks. And that was quite literally October 2022 was the bottom of this bear market. And the 3 years, incredibly strong. And if you come up to 2026, years of good times, high prices, time to sell stocks, and values of all kinds. And so AI, all these stocks ripping higher. So 2026, keep in mind, could be a very, very interesting year. So yeah, I think the demand for AI is real. David says there are a lot of companies that are trying to capitalize from AI but are not profitable and don't offer meaningful technology. Yeah, the banner cycle haunts my dreams. So yeah, we'll see if there's any ripple effect into going into next year, and if unemployment starts to creep up on the back of artificial intelligence and any kind of displacement in the jobs market, and how that's going to affect the economy or the markets as well. So yeah, a couple things on the radar. So after 2026, the next big opportunity comes in 2032. So are we talking about 6 years? 6 years of pain? Is that what we're really looking forward to? From 2026 all the way to 2032? Because after 2007, as you can see, that both 1999 and 2007 are on there, right? So they're both the years where the subsequent years were absolutely brutal. I mean, 2000s, the dot-com bubble crash, 2008, the great financial bubble bursting, and then 2016, if we come over to the S&P 500, we'll just come over to the monthly chart. So that was, of course, 2000s, that was 2008, and then 2016, we didn't quite get a big sell-off, but we did get a 15% correction in the S&P 500 all of 2016. So most of 2016, right? And then, of course, we had the COVID crash, which 2019 is also there. You can't see it. There we go. So all the way up here, 2019, years of panic. So years in which panics have occurred and will occur again. So 2019 and the next panic, apparently 2035. 2035 is going to be the year of panic, apparently, is what Benner Cycle says. Soaring simulator, make a spreadsheet with how much cash to deploy in percentage each time market goes down 5, 10, 20%. I mean, we have a spreadsheet very similar to that. We've got the liquidity framework, which we have talked about. And a lot of that depends on your level of conviction as well. But really, if you come over to the MoneyVest Index, as we have gone over literally so many times, I'll just log back in and show you. But MoneyVest Index, anything under 3, 2.5, and 3 is uncertainty. So that's, good 5 to 10% deployment. And then anything below, 2 and 2.5, another 20 to 30%. Anything under 2, right? If we're in the ones, that's where you are a lot more aggressive in the market. So we have a very similar version of that. MVTS, I would consider as a penny stock. Please take a look. Maybe it will fit the candidates to a swing trade. Enjoy. So we'll take a look at it, and markets are going to open here. MVTS, or are you talking about NVTS? Is it Nevitas? Is what you're talking about? Vault. So $9. Yeah, $9 is fine. I mean, $9 is not a penny stock. I mean, it's almost a $2 billion market cap company. And support level is going to stay right here, $7.75, incredibly oversold. So if you do see a nice little bump here, resistance all the way up to as much as $17, $18. I know Kevin's trading that in the alpha account pretty regularly. So, all right. Yeah, Michael Burry even mentioned, right, in his tweet, MVST. Oh, okay, MVST here. 1 second. Oh, Microvast Holdings, 440s, about a 1.4 billion market cap. I'll look into this stock and what this is for sure. But this looks like a nice higher high, higher low pattern coming down to a pretty decent support. At the 50 EMA. If it does sell off further, I'd be looking at $3 as a better entry point for MVST, and resistance all the way up to $7. So incredibly volatile for sure. And that would be that resistance to watch. All right, everyone. So markets open now. QQQ's gapping up a little bit, 0.5%. We got the S&P 500 up over 25 basis points as well. We got the NVIDIA stock. We got Tesla. Most of Magnificent 7 is pushing higher. And we got volatility back in the low to mid 17s right now, with S&P 500 essentially trading sideways once again. So we've seen a lot of consolidation after hitting new all-time highs. Once again, we're back in this kangaroo market of selling off and pushing right back up. But that 50 EMA is going to be the most important EMA right now for this market. So TrueLeaf, Srinivas, we already exited out of that TrueLeaf. Like I already sold a lot of my position like a couple of years ago. It's not even part of my portfolio. It's been gone for over 2 years. Execution risk, right? So this entire industry has faced a lot of execution, a lot of political risks, a lot of regulation, a lot of approvals. And as a result, with the couple acquisitions that they did, revenues struggled, profitability struggled. So I'm already out from 2 years ago on TrueLeaf. So yeah, that's where we are. Again, market's open. We are starting to see a bit of a pullback right at the open here. But once again, thank you so much for joining everyone on this Wednesday Market Open live stream. Inflation numbers are scheduled, but again, not sure if you're going to get them. Links are going to be down below if you're interested in joining us, and hope you all have a fantastic Wednesday morning of trading. Take care.